Welcome to the deep dive, where we try to cut through all the noise and really deliver the insights you need to be well informed.
Yeah, get straight to the point.
Exactly. And today we're plunging into the, well, pretty remarkable story of Applied Digital Corporation, that's ticker APLD.
APLD. Yep. See a lot of action lately.
Actions, putting it mildly, their stock didn't just climb after the Q4 2025 earnings report. It it absolutely surged over 30% in a single day. Just blew past expectations.
It really did. Caught a lot of people by surprise.
So the big question we're tackling for you today is this. Was that explosion, a pivotal moment? Does it signal a real sustainable shift for APLD as a key player in the AI revolution?
Or is it maybe just a high-stakes gamble, packed with risk, like some of the skeptics are saying?
That's what we want to find out. We're going to peel back the layers, see what it really means.
And just a quick note for everyone following APLD closely, we're planning to cover earnings for this company, like within minutes of release for their upcoming reports.
Oh, good point. Yeah, definitely stay tuned for those rapid-fire updates if you're tracking this one.
Definitely.
Okay, so our mission today is to get past the headlines, dive deep into their recent APLD stock deep research analysis. We want to figure out if they've genuinely pulled off this pivot from, the wild world of crypto mining.
Which was their origin story, really.
Right, into being a foundational infrastructure provider for this whole AI boom. We'll look at their strategy, the financial reality, and really unpack what the market's reaction means for you, the curious learner. Let's get started on this deep dive. Chapter 1, business analysis.
All right, Chapter 1.
So this huge surge, is it real? Is it sustainable? To understand that, we need to know what Applied Digital is today. They're NASDAQ, APLD, based in Dallas, Texas.
Right, and they definitely changed. They used to be Applied Blockchain, Inc., but now the focus is squarely on AI.
And this analysis catches them right after that big Q4 report and the CoreWeave partnership news, July 31st, 2025. Stock closed at $13.14 then. So what's their core business now?
Well, at its heart, APLD designs, builds, and runs next-gen digital infrastructure. They've really shifted from crypto to being a key player in high-performance computing, HPC, and AI markets. They actually have 3 different segments.
Okay, walk us through them. Which one's the big growth driver?
First, you've got their data center hosting business. That's kind of the legacy operation, providing space, power, cooling, mostly for crypto mining clients. It's stable, long-term contracts, 286 megawatts fully contracted in North Dakota.
So, okay, the foundation.
Exactly.
Huh.
But the real strategic focus, the growth engine, is their HPC hosting business. This is where they're building specialized data centers specifically for HPC and AI. The money comes from leasing huge chunks of capacity to hyperscale clients. Think big tech, long-term deals, that massive CoreWeave deal. That's the prime example of this new direction.
Got it. And number 3.
That's their cloud services business, under the name Psi Computing. It offers GPU as a service, GPU-AA, a SOGA. So direct access to computing power for AI stuff. But interestingly, the board's looking at strategic alternatives for this part, maybe selling it off.
Why is that?
Well, it probably helps clarify their focus on being an infrastructure provider, Long-term leases for HPC hosting. That gives them much better revenue visibility, more stability than, say, direct crypto mining, which they stopped doing back in 2022. It also avoids potential conflicts with their big hosting clients.
That makes sense. Focus is key. So tell me about these AI factories they keep mentioning. What makes them special?
Yeah, that's their flagship product, no doubt. AI data centers, or AI factories as they call them. And these aren't just retrofitted old buildings. They're purpose-built from scratch, designed for crazy power densities up to like 150 kilowatts per rack. Yeah, and they use advanced cooling, like direct-to-chip liquid cooling. You absolutely need that for the top-end AI GPUs like the latest ones from NVIDIA. They do still have their cryptocurrency hosting infrastructure running for those existing clients.
Right, keep the lights on there.
Exactly. But the AI factories, that's the future they're building.
Sounds very specialized. How do they compare to the giants? Digital Realty, Equinix, are they even in the same league?
Well, scale-wise, no. They're still much smaller than those huge data center REITs. But APLD has definitely carved out a very specific and pretty compelling niche. Their market cap jumped to between $2.9 and $3.2 billion after that earnings report. So they're now firmly a small to mid-cap growth company.
Okay.
Right now, they have that 286 milliW of crypto hosting, but the future is all about hyper growth. They've got 400 mW coming online just from CoreWeave, and they talk about a development pipeline spanning multiple gigawatts. That's a huge ambition for a company their size.
They use the tagline different by design. What's the core idea there? What makes them different?
It really sums up their whole approach. Delivering ultra-low-cost, high-efficiency infrastructure for this accelerated computing stuff. It starts with strategic site selection. They deliberately pick places like North Dakota. Why? Abundant, reliable, low-cost power, often stranded power, sometimes from renewables.
Stranded power, meaning?
Power that's generated but maybe hard to transmit elsewhere, so it's cheaper locally. Then, their power-first engineering. The whole facility is designed around handling extreme power densities. That's the primary constraint, not an afterthought.
Right.
And this leads to amazing cost and energy efficiency. They use the cold client. North Dakota gets cold for over 200 days of free cooling a year, plus innovative liquid cooling. All this gets them a power usage effectiveness, or a PUE, of just 1.18.
And 1.18 is good.
Oh yeah, that's incredibly efficient, close to best in class. It means very little energy is wasted on cooling compared to powering the actual computers. It's a huge cost advantage. Management actually estimates this could save a 100 million W customer something like $2.7 billion over 30 years compared to building in other regions. Billion. Wow, those are serious savings. So it sounds like they're perfectly positioned at the intersection of, data center growth and this AI explosion.
Absolutely. The HPC market was already over $50 billion in 2023, projected to double by 2032. And it's driven by what they call insatiable demand for AI computing power. You see hyperscalers like Microsoft planning $80 billion in spending just for 2025. Meta's pouring billions into. It's a massive tailwind for APLD.
Okay, but who are they actually competing against? It must be getting crowded.
It is varied. You've got the established data center REITs, Digital Realty, Equinix. They have scale, but maybe aren't optimized for AI-specific power needs. Then you have other pivoting crypto miners like Riot Platforms, Marathon Digital. They also know high-power stuff, so they could be direct competitors.
But they have similar skills.
Exactly. And then the big long-term threat is always hyperscaler insourcing. Could Amazon, Microsoft, Google just decide to build all their own data centers eventually? That's always a risk for third-party providers.
Yeah.
With all this demand, why aren't more companies just flooding into this space? What are the real barriers?
They're pretty significant. First, it's hugely capital intensive. Hundreds of millions, even billions, for just one campus. Second, power procurement. Getting your hands on hundreds of megawatts of reliable, cheap power. That is the bottleneck. It's incredibly hard to do and replicate.
The key resource.
Totally. You also need deep technical and operational expertise for these high-density, liquid-cooled facilities. It's not standard stuff. And finally, customer validation. Hyperscalers do intense technical checks, APLD getting CoreWeave, plus they mentioned 2 other investment-grade hyperscalers. That's a massive differentiator. It's like a stamp of approval.
Yeah, that CoreWeave deal keeps coming up. Sounds like a huge competitive advantage, almost like a public endorsement.
It absolutely is. Big boost to their brand strength and recognition. Validates that different by design idea. Plus, they have those structural cost advantages from the cheap power and efficient design. And think about switching costs. Once a hyperscaler signs a 15-year lease, integrates all their tech, it's incredibly costly and disruptive to move. That creates really sticky, annuity-like revenue.
Makes sense.
Their portfolio of secured power agreements is a critical asset, very hard to copy, and they've shown they can build fast, rapid, specialized construction, cutting build times from maybe 24 months down to 12, 14. That's a crucial weapon in this race for AI capacity. It's basically a smart arbitrage play turning cheap energy into valuable computing power and selling off the cloud services part. That just clarifies their role as a pure infrastructure player. Might even set them up for a reconversion down the line.
Okay, let's unpack this. And hey, as we dive into more companies like this, remember to like and subscribe to Stock Analytics AI on YouTube. If you're a member, you can suggest stocks in the comments for future deep dives, and we'll prioritize them.
Good reminder.
Chapter 2.
Management evaluation.
Chapter 2, Management.
Right. We've looked at the business engine, but who's actually steering this thing? Let's talk leadership. Wes Cummins, the CEO. Seems like he's the main architect of these big changes. What's his background?
Yeah, Wes Cummins, co-founder and CEO. He's got over 2 decades in finance, tech investing, clearly positioned as a strategist, a capital allocator. And he really proved that during what the report calls his defining moment. Remember that Chinese government crackdown on crypto mining back in May 2021?
Oh yeah, that must have been an existential threat for them back then.
Totally. Their whole business was tied to it. But Cummins and his team showed, well, remarkable agility. Almost overnight, they pivoted the entire company focus to building data center infrastructure over here in North America.
Wow. Just like that.
Pretty much. That move didn't just save the company, it set the path they're on right now towards high-power AI infrastructure. It's a really strong example of leadership turning a crisis into a huge new opportunity.
How are they on communication? Are they transparent with investors, the public? Based on things like the Q4 2025 earnings call, their public communication seems pretty confident, optimistic, and reasonably transparent. Wes Cummins even threw out a huge goal, hitting $1 billion in annual net operating income in the next 3 to 5 years.
$1 billion. That's ambitious.
Very. But they do seem to balance that optimism with being candid about the challenges, tough negotiations with hyperscalers, supply chain issues, the fact that this is a super capital-intensive business, and importantly, no major ethical or reputational red flags noted in the research.
Good to know. Now, given how much money this takes, how are they actually allocating capital? Where's the money going?
It's an aggressive, almost single-minded focus on organic growth. Building these HPC data centers, they deployed nearly $1 billion in assets just in the past year, almost all on new facilities.
$1 billion? Where did they get that?
Through a pretty sophisticated, multi-pronged financing strategy. They've got a massive $5 billion partnership with Macquarie Asset Management, a $375 million facility with Sumitomo Mitsui Banking Corporation, specifically for their Ellendale campus. $150 million in convertible preferred equity. And they're actively using at-the-market, or ATM, stock offerings plus preferred stock sales. Raised another $269 million that way just after Q4.
Remind us how that ATM program works.
Sure, it basically lets them issue new shares directly into the open market over time, usually in smaller chunks. It's a flexible way to raise capital as needed without doing a single, huge, potentially disruptive offering. And yeah, they're clearly choosing to build from scratch greenfield development rather than buying other companies. No major M&A activity.
Okay, that's a ton of financing. But I saw something interesting, an $84 million share repurchase in late 2024. Why would a growth company, needing all this cash, buy back its own stock?
Yeah, that was really unusual, especially since it happened around the same time they did a $450 million convertible notes offering. It's seen as a very powerful signal for management, basically saying, hey, we think our stock is seriously undervalued right now, even while they're in this heavy growth and investment phase. It shows a lot of conviction in the future share price.
Interesting signal. And dividends, I assume that's a no?
Correct. APLD doesn't pay a dividend, no plans to. Yeah. Every bit of capital is being plowed back into growth.
Okay. What about return on invested capital, ROIC? I imagine it doesn't look great right now.
You're right, it doesn't. It's deeply negative, somewhere between roughly negative 5% and negative 18%. But, and this is key, that's kind of expected at this stage.
Oh.
Because they've poured billions into building these assets, these data centers, that aren't fully built or operational yet, if they haven't started generating significant revenue or returns. So the negative ROIC reflects the investment phase, not necessarily operational failure. The whole bet is that this number will dramatically flip positive as these facilities, especially the big CoreWeave ones, come online and start churning out cash.
Chapter 3, Financial Analysis.
All right, let's dig into the numbers. Chapter 3, Financials.
Okay, so market cap first. Where do they stand now after that big jump?
As of July 31, 2025, post-surge, Applied Digital's market cap was sitting between $2.9 billion and $3.2 billion. So yeah, firmly small to mid-cap growth territory.
And revenue growth. You mentioned the pivot. How has that looked over the last, say, 5 years?
It's been pretty explosive, actually. Think about this. Fiscal 2021, they had just $1.5 million in revenue. By fiscal 2024, $136.6 million.
Wow, that's incredible growth.
It really is. Over 9,000% in 3 years. Shows how fast they moved. Now, fiscal 2025 saw a more modest 6% increase, up to $144.2 million. That kind of reflects the older crypto hosting business maturing while they were pouring money into the HPC side. But importantly, Q4 2025 alone showed 41% year-over-year growth. And remember, the really big revenue jump from that multi-billion-dollar CoreWeave deal, that's still mostly in the future. It's not fully baked into these numbers yet.
Right. The big wave is still coming. So if they're investing so heavily, what about profit margins? Gross operating net, I'm guessing they're not great.
Yeah, not great is putting it mildly right now. Their current margin profile is, well, extremely weak, which again is pretty typical for where they are in their life cycle. Gross margin is thin, only about 5.6%. Operating margin is way down at negative 38.8%. And net profit margin is a whopping negative 110.5%.
Minus 110%.
Yep. So they are nowhere near in GAAP profitability right now. The whole investment thesis relies on those future HPC revenues getting to massive scale and driving significant margin expansion later on.
Okay, so if they're not profitable, free cash flow, are they just burning through cash?
They are. You look at the trend, free cash flow has been consistently negative and getting more so, like a deficit of almost $470 million in fiscal 2025. But, and this is the crucial context, that cash burn is a direct expected result of their strategy.
How so?
They're spending aggressively to build these huge, long-lasting assets that will generate revenue for years, but they just aren't generating it yet. It's the investment period. It's not necessarily a sign the business model itself is failing, just that it costs a lot up front.
Got it. And earnings consistency over, say, the last 5-10 years?
No consistency there. They've posted significant and generally growing net losses for each of the past 5 fiscal years. Again, totally consistent with a high-growth company reinvesting everything back into expansion.
Okay, let's talk financial stability. Debt-to-equity ratio, always a key risk metric.
It is high. Their balance sheet is definitely highly leveraged. Debt-to-equity ratio is 2.00. That means they're using twice as much debt as equity to fund their assets. As of the end of May 2025, total debt was substantial, around $688 million. That leverage definitely increases financial risk, especially if interest rates keep rising.
And short-term liquidity, current ratio. Are they managing okay day to day?
Looks tight. The current ratio is between 0.70 and 0.77. Anything below 1.0 means current liabilities are greater than current assets, which can be a concern. However, they seem to be managing this through their financing facilities and that ATM program we talked about, giving them ongoing access to cash to bridge gaps while funding those big projects.
Right. And dividends, we already covered that, not applicable.
Correct, no dividends.
Okay, valuation. Since they're losing money, the standard price-to-earnings ratio is kind of useless, right? Negative PE doesn't tell us much.
Exactly. It's negative between -7 and -9 roughly, but meaningless here. So we look at price-to-sales PS instead, and APLD's PS is high, around 13.38.
How does that compare to others in the space?
It's a significant premium. Look at established data center REITs. Digital Realty is around 10.5. Equinix is about 8.6. Even compared to digital asset peers like Riot Platforms at 9.2 or BitDeer at 8.6, APLD is trading at a higher sales multiple.
So what does that premium tell us?
It tells us the market is pricing in a lot of future growth. Expectations are clearly very high for APLD right now. Our research includes a table 2, relative valuation peer comparison that lays this out clearly.
Okay, so beyond just comparing multiples, how do we think about their actual intrinsic value?
That's where we turn to discounted cash flow analysis, or DCF. It's really a cornerstone of fundamental investing. The basic idea is to estimate all the future free cash flow a business might generate over its lifetime, and then discount that back to what it's worth today. It helps us look past the current losses to the potential long-term value.
Right, so what does our educational DCF model suggest for APLD's intrinsic value?
Based on our model, the estimated intrinsic value range for Applied Digital falls somewhere between $10 and $15 per share. Now, that's a pretty wide range.
Why so wide?
Because there's just a high degree of uncertainty here. The valuation is very sensitive to the assumptions you make about the future, given how much depends on successful execution and growth.
Makes sense. What are the key assumptions driving that $10 to $15 range?
2 big ones. First, the revenue growth rate. That's heavily anchored by the huge $11 billion CoreWeave contract. We phase that in as the new facilities are expected to come online. The first 100 milliW late 2025, the next 150 milliW mid-2026, another 150 milliW in 2027. Beyond CoreWeave, we assume more conservative growth.
Okay, that's revenue. What's the other key assumption?
The discount rate, or weighted average cost of capital, WACC. We used a high rate here, 12% to 15%.
Right.
That's justified by the significant risk profile, all that debt, the negative cash flows, the execution risk on these huge builds, plus a really high stock beta of almost 6.
Beta of 6. So 6 times more volatile than the overall market.
Roughly, yeah. That level of volatility demands a higher discount rate to compensate investors for the extra risk they're taking on.
Chapter 4, market sentiment.
Moving on. Chapter 4, market sentiment.
Okay, let's take the market's pulse. After that strong Q4 report, what's Wall Street saying? Are analysts bullish?
Overwhelmingly bullish, yeah.
Yeah.
The consensus rating from the 9 analysts covering it is a strong buy. And after the earnings, several firms hiked their price targets significantly. Craig-Hallum went up to $18, Roth MKM to $17.50, Citizens JMP to $16. Needham, H.C. Wainwright also raised theirs.
So where does the average target sit?
The average 12-month price target is around $14.94, with the high end reaching $18.90. So Wall Street definitely sees more upside from that $13.14 level we saw on July 31st.
And the general media buzz, is it positive too?
Very positive, yes. The earnings beat and that huge CoreWeave expansion really drove the narrative. You see headlines positioning APLD as this key player in the AI build-out, maybe even an AI stock that could go parabolic. That kind of talk definitely attracts momentum traders.
Okay, so analysts are bullish, media's positive, but then there's this fascinating counterpoint. The short interest, what does that tell us?
Yes, the shorts. It reveals, well, deep and entrenched skepticism. Short interest as a percentage of the float is exceptionally high. We're talking 31.5% to almost 38%. That's 60 to 65 million shares being bet against the company.
Wow, that's huge. What does that signal?
It's a major bearish indicator. It means a significant chunk of the market believes the business model is fundamentally flawed or just unsustainable long-term. It really makes APLD a battleground stock. You have the bulls focusing on the growth story and the bears pointing to the risks in the financials. That recent price surge probably caused a lot of pain for those short sellers and sets up the potential for a short squeeze if more good news hits.
A real tug of war. So technically speaking, how does the stock look relative to its moving averages after that jump?
Technically, it looks strong. On July 31st, that $13.14 net closing price was well above its 50-day moving average, which was around $10.11. That's generally a bullish signal.
And the longer-term trend, the 200-day.
Same story. Significantly above its 200-day moving average, which was down near $8.11. That's a classic bullish indicator suggesting a sustained uptrend. The earnings report really blasted it through those key levels, reinforcing the positive momentum, technically speaking.
Chapter 5, ownership structure.
Okay, Chapter 5. Who owns this stock?
Right, let's look inside the ownership structure. Who are the main holders?
Well, institutional ownership is quite high, actually, somewhere between 61% and 66%. That suggests growing credibility among the big money managers, the funds. Top holders include names like Hood River Capital Management, BlackRock, the Vanguard Group, standard players.
Anything unusual in the list?
Okay, this is really interesting. NVIDIA Corp holds a 3.43% stake.
NVIDIA, the chip maker.
The very same. And that's viewed as more than just a financial investment. It's seen as a powerful strategic endorsement. It signals that NVIDIA, arguably the most important company in the AI hardware space, believes APLD is a critical partner for building out the infrastructure needed for their GPUs. That's a huge vote of confidence.
That is significant. What about insiders? Are the executives and directors holding onto their shares or selling?
Insider ownership is also pretty significant, somewhere between 10% and 23%. CEO Wes Cummins is a large individual shareholder himself, which helps align his interests with other shareholders. That's generally positive.
Good.
But the report does highlight a more cautionary picture recently. There's been net selling by insiders over the last 12 months. Specifically, in the most recent 3-month period before the report, insiders sold about 42,500 shares and made no open market purchases.
Should we be worried about that?
Well, some insider selling can be for planned reasons, like taxes or diversification. It doesn't automatically mean they've lost faith, but zero purchases and consistent net selling. It's definitely a data point investors should be aware of and keep an eye on.
Okay. And how concentrated is the ownership overall? Do a few big players control a lot?
It's relatively concentrated, yeah. The top 11 shareholders control about 52% of the company.
Is that good or bad?
It's kind of a double-edged sword. On one hand, it means those large holders can have significant influence on strategy, which could be good if they're aligned with long-term value. On the other hand, it can also lead to higher stock price volatility if one or two of those big holders decide to sell down their position. Makes the stock potentially more jumpy.
Chapter 6, risk assessment.
All right, Chapter 6. Time to look at the risks.
Okay, the critical Chapter 6, risk assessment. Let's use that SWOT framework. Strengths, weaknesses, opportunities, threats. Start with the internal strengths. What are APLD's core competencies?
Okay, strengths. Number 1, that agile capital market savvy management team, proven by the China pivot. 2, their demonstrated ability to land huge long-term contracts, like the CoreWeave deal that's massive validation. 3, their specialized expertise in low-cost, high-density AI data centers. And 4, those strategic land and power assets they've secured in cheap energy regions.
Got it. Now the flip side, internal weaknesses. What could hold them back from within?
Weaknesses are mainly financial, as we discussed. That highly leveraged balance sheet debt to equity of 2.0 and weak liquidity. like the current ratio being under 1.0. Then there's the history of unprofitability and burning through cash. Also, a big one is execution risk. These are massive, complex construction projects. Delivering them on time and on budget is absolutely critical and far from guaranteed. And finally, their dependence on external capital markets to fund all this growth. If that funding dries up, they could be in trouble.
Okay, now looking outward. Opportunities. What's the potential upside in the market?
The biggest opportunity is just the massive secular growth in demand for AI and HPC infrastructure. They are right in the middle of it. Linked to that is the ability to sign more big leases with other hyperscalers beyond CoreWeave. Then there's the potential for a future REIT conversion, which could lower their cost of capital significantly. And as mentioned, selling off the cloud services business could help them streamline and focus.
Makes sense. And finally, the threats. What external challenges could derail them?
Competition is intense. From the big established REITs, potentially from other pivoting miners, and always that threat of hyperscalers just building their own stuff. Hyperscaler insourcing. Supply chain disruptions are a constant risk for critical gear like generators, switchgear, even the GPUs themselves. Delays mean cost overruns. Rising interest rates are a major threat given their debt load. And then there are geopolitical risks, specifically potential U.S. tariffs.
Let's zoom in on those last two. How sensitive are they really to things like inflation and interest rates?
Highly sensitive, especially to interest rates. Because they rely so much on debt to build these expensive facilities, any increase in rates directly hits their borrowing costs, squeezes potential profitability, and makes raising new debt harder or more expensive. Persistent high inflation could also drive up construction and labor costs, further pressuring margins.
And those potential U.S. tariffs in 2025, how specifically could that impact APLD?
Yeah, that's flagged as a material threat. The concern is new tariffs on imported IT and networking hardware, servers, switches, that kind of thing. Could be 10%, maybe even 25%. For APLD, that translates directly into higher capital expenditures for building out their data centers. It can make projects less profitable or force them to raise even more capital than planned just to finish the builds. It's a significant potential headwind.
Chapter 7, Conclusion.
Okay, wrapping it up. Chapter 7, Conclusion.
All right, let's bring it all together. After digging through all this, what does it mean for you? Let's synthesize. Start with the bull case. What are the key reasons to be optimistic about Applied Digital?
The bull case is pretty clear. 1, they've successfully pivoted into this booming AI infrastructure market. 2, that $11 billion CoreWeave contract is huge. It validates their model and de-risks a significant chunk of future revenue. 3, they have an agile, savvy management team that's navigated tough times before. And 4, they seem to have a real competitive edge with their low-cost, high-efficiency, power-dense data center design.
Okay, sounds compelling. Now the bear case. What are the biggest risks and reasons for caution?
The bear case is just as clear, really. 1, their financial position is precarious, lots of debt, tight liquidity, burning cash, and very dependent on friendly capital markets. 2, there's immense execution risk. Their whole future value depends on successfully building these massive, complex projects on time and on budget. It's a huge if. 3, that exceptionally high short interest shows significant market skepticism isn't going away. And 4, the competitive landscape is tough, including that threat of hyperscalers deciding to build it themselves.
So pulling back to valuation, remind us of the estimated intrinsic value range from the educational DCF model.
Our model put the estimated intrinsic value between $10 and $15 per share.
And with the stock price at $13.14 back on July 31st, where does that leave us?
Well, $13.14 falls squarely within that $10 to $15 range. What that suggests is that the market, at that point in time, was probably efficiently pricing in the successful execution of the CoreWeave contract and the initial success of their AI pivot. Not necessarily cheap, not necessarily wildly overpriced, but reflecting the known good news and some of the risk.
Okay, so what's the final provocative thought for you, the listener, to chew on as you think about APLD's future?
Here's something to consider. The current valuation, while maybe fair based on CoreWeave, might not fully capture the massive potential upside if APLD manages to land more big hyperscaler deals, really proving out their different by design advantage at scale. But conversely, it also might not fully discount just how significant the financial and operational risks really are if things don't go perfectly according to plan.
So it really boils down to,
Ultimately, Applied Digital looks like a classic high-risk, high-reward proposition right now. Its future value is going to be almost entirely determined by management's ability to flawlessly execute on this incredibly ambitious, complex, but potentially hugely rewarding AI infrastructure roadmap. Execution is everything here.
Absolutely. Well, thank you for joining us on this deep dive. We really hope you feel much more informed about Applied Digital Corporation and all the complex dynamics swirling around it.
Hope it was helpful.
Before you head out, please do hit that like and subscribe button on the Stock Analytics AI YouTube channel. And remember, members paying €4.99 a month get priority on tickers for these deep dives. We're planning to cover all of the S&P 500 stocks over the next few months, and members get that exclusive priority access.
And if you just want a one-off deep dive on a stock you're interested in, you can always drop us a super thanks in the comments.
Great point. Okay, one last thing.
The disclaimer, yes. This analysis was generated by an AI system for educational purposes only. It should definitely not be considered financial advice. Please, always do your own research, consult with a qualified financial advisor before making any investment decisions.
Couldn't have said it better myself. Thanks again for tuning in.